Welcome to the definitive guide on building wealth through index fund investing. The most important point for any beginner to understand is that you do not need to be a Wall Street genius to achieve financial freedom. Index funds represent the most efficient and reliable vehicle for long-term wealth creation because they allow you to own a tiny piece of hundreds or even thousands of companies simultaneously. The reason this strategy is so effective is that it removes the guesswork and human error associated with picking individual stocks. Imagine trying to guess which single company will dominate the next decade. It is a gamble that most professionals lose. However, by using an index fund that tracks the 500 largest companies in the country, you are betting on the collective growth of the entire economy rather than a single entity. This is the simplest way to build a massive nest egg while focusing on your actual life. Diversification is often called the only free lunch in the world of finance. The main point here is that index funds provide instant diversification, which drastically lowers your overall investment risk. The reason this matters so much is that individual companies can and do fail due to poor management or changing technology. If you put all your money into one stock and that company goes bankrupt, your savings vanish. Think about the history of the stock market, where giants of the past have completely disappeared, while the market as a whole continued to climb to new heights. By spreading your money across an entire index, you ensure that the failure of one or two companies is offset by the growth of hundreds of others. This structural safety net is why index funds are the foundation of any intelligent portfolio. You are essentially securing your financial future by embracing the power of numbers. One of the most critical factors in your long-term success is the impact of investment fees. You must prioritize low expense ratios because high fees are the silent killers of wealth. The reason behind this is the mathematical reality of compounding over several decades. Even a seemingly small 1% fee can eat away nearly 1/3 of your potential wealth over a 30-year investing horizon. Consider two investors who both start with $10,000 and contribute monthly. If one pays a 1% fee to a traditional mutual fund, and the other pays 0.03% to a low-cost index fund, the difference in their final balances will be staggering. The index investor keeps more of their own money working for them rather than handing it over to a fund manager. Keeping your costs as low as possible is the most guaranteed way to increase your total returns. The debate between passive and active management has a very clear winner for the vast majority of people. Passive index funds consistently outperform the majority of professional fund managers who try to beat the market. The reason for this performance gap is that the market is highly efficient, and the costs of constant buying and selling add up quickly. Statistics show that over any 15-year period, more than 90% of active managers fail to beat a simple index like the S&P 500. For example, a professional might make a brilliant trade one year, but they rarely repeat that success consistently enough to cover their high salaries and transaction costs. By choosing a passive approach, you are choosing to accept the market return, which is statistically higher than what most experts achieve. You are trusting the collective wisdom of the market rather than the ego of a single stock picker. Time is the most powerful tool in your investing arsenal due to the miracle of compound interest. The point is that starting as early as possible is more important than the amount of money you start with. This works because your initial investment earns a return, and then those returns earn their own returns in a virtuous cycle that grows exponentially. If you look at an investor who starts at age 20 and stops at age 30, they will often end up with more money than someone who starts at age 30 and continues for 30 years. This happens because the money has more time to double and redouble. By starting your index fund journey today, you are giving your future self the gift of time. The longer your money stays in the market, the less work you have to do to reach your financial goals. Compound interest turns small, regular contributions into life-changing wealth. Most major index funds are organized using a system called market capitalization weighting. The main point is that this structure automatically ensures you are always invested in the most successful companies. The reason this is beneficial is that it gives more weight to the largest and most valuable companies, while reducing exposure to those that are shrinking. For instance, as a technology company grows to become a trillion-dollar giant, it naturally occupies a larger percentage of your index fund. Conversely, if a retail chain begins to fail and lose value, it automatically becomes a smaller part of your holdings without you having to sell a single share. This means your portfolio is constantly self-correcting and moving toward quality. You do not need to monitor the news to see which companies are winning, because the index does that work for you. It is a built-in mechanism for staying relevant in a changing economy. The S&P 500 is the most famous index in the world and serves as the gold standard for many investors. The point is that this index tracks the 500 largest publicly traded corporations in the United States. The reason it is so popular is that these companies represent about 80% of the total value of the American stock market. When you buy an S&P 500 index fund, you are owning pieces of companies like Apple, Microsoft, Amazon, and Visa all at once. If the American economy is doing well, these companies are generally the ones leading the charge. Using this index as your primary investment vehicle provides a high level of stability and growth potential rooted in the strongest economy on Earth. It is a reliable and time-tested foundation that has historically returned about 10% annually before inflation. For many investors, a single fund tracking this index is all they ever need. While the S&P 500 is great, a total stock market index fund offers even broader exposure to the entire corporate landscape. The main point is that these funds include large, mid, and small-sized companies in one package. The reason this is attractive is that it allows you to capture the growth of smaller companies that might become the next industry leaders. For example, many of today's tech giants started as small companies that would not have been in the S&P 500 during their initial explosive growth phases. A total market fund like those offered by Vanguard or Fidelity holds thousands of different stocks. This means you own every corner of the market from the smallest startup to the largest conglomerate. This level of total coverage further reduces your risk and ensures you never miss out on any sector's success. It is the ultimate expression of the philosophy that you should own the whole haystack instead of looking for the needle. True diversification requires looking beyond the borders of your own country. The point is that including international index funds in your portfolio protects you from domestic economic downturns. The reason this is necessary is that no single country dominates the global economy forever. There have been decades where international markets significantly outperformed the United States. For instance, while American tech might be booming now, there may be periods where European or Asian markets see higher growth due to different economic cycles or innovations. By holding a total international stock index fund, you are making a bet on human progress across the entire planet. This creates a global safety net that balances your portfolio when one region faces a recession. Diversifying geographically ensures that your wealth is not tied to the political or economic fate of just one nation. It provides a more stable path to long-term growth. Dividend reinvestment is a simple feature that can drastically accelerate your journey to financial independence. The main idea is that you should set your index funds to automatically use any cash payouts to buy more shares. The reason this is so effective is that it creates a compounding effect on the number of shares you own, not just their price. Imagine your index fund pays a small dividend every 3 months. If you take that cash and spend it, your share count stays the same. But if you use that cash to buy more shares, you will receive an even larger dividend next time because you own more of the fund. Over several decades, this process leads to a snowball effect where your share count grows exponentially without you ever adding more of your own money. Most brokerages offer this as a free service called a dividend reinvestment plan. It is a powerful way to fuel your wealth machine. Many people struggle with the fear of investing at the wrong time, but dollar cost averaging solves this problem. The point is that you should invest a fixed amount of money at regular intervals, regardless of what the market is doing. The reason this works is that it removes emotion from the equation and uses market volatility to your advantage. For example, if you invest $500 every month, you will naturally buy more shares when the market is down and prices are cheap. When the market is high and prices are expensive, your $500 will naturally buy fewer shares. This process lowers your average cost per share over time and prevents you from making the mistake of waiting for a perfect moment that never comes. Consistency is far more important than timing. By automating your investments, you ensure that you are always moving forward, even during periods of market uncertainty. Index funds are famous for their tax efficiency compared to other types of investments. The point is that you get to keep more of your returns because index funds trigger fewer taxable events. The reason for this is that they have very low turnover, meaning the fund manager rarely sells stocks within the fund. In a typical actively managed fund, the manager might sell dozens of stocks every year to chase trends, which creates capital gains taxes that you have to pay. In contrast, an index fund only sells a stock if it is removed from the index, which happens very infrequently. For example, if you hold an index fund in a taxable brokerage account, you might go years without having to pay significant capital gains taxes. This allows your money to stay invested and compound without being depleted by the government every year. Tax efficiency is a boring but essential part of maximizing your final net worth. Starting your journey requires choosing the right brokerage and the right type of account. The point is that you should use low-cost providers and prioritize tax-advantaged accounts. The reason this is vital is that accounts, like a 401k or an individual retirement account, offer massive tax breaks that a standard brokerage account does not. For instance, investing through a Roth IRA allows your money to grow completely tax-free, meaning you will never pay taxes on the gains when you retire. You should look for reputable brokerages like Vanguard, Fidelity, or Charles Schwab because they offer the lowest fees in the industry. Once you open an account, simply search for a broad market index fund or an exchange-traded fund that matches your goals. Setting up this structure correctly at the beginning ensures that you are not losing money to unnecessary taxes or administrative fees as your balance grows. The hardest part of index fund investing is not the math, it is the psychology of staying the course. The main point is that you must resist the urge to sell your funds during a market crash. The reason this is so important is that every single market downturn in history has been followed by a recovery and new all-time highs. For example, investors who panicked and sold their index funds during the 2008 financial crisis missed out on one of the greatest bull markets in history that followed. Those who did nothing and stayed invested saw their portfolios recover and then double or triple in value. You have to accept that volatility is the price you pay for long-term returns. A market crash is actually a sale where you can buy more shares at a discount. Maintaining a long-term perspective and ignoring the daily news cycle is what separates successful investors from the rest. In summary, index fund investing is the most accessible and effective path to wealth because it combines diversification, low fees, and the power of the entire economy. We have covered why index funds beat active managers, how compound interest works in your favor, and the importance of staying consistent through dollar-cost averaging. By choosing broad market funds and reinvesting your dividends, you are building a financial engine that works for you 24 hours a day. Remember that the best time to start was years ago, but the second best time is today. Your future self will thank you for the discipline you show right now. If you found this deep dive into index funds helpful, please hit the like button and subscribe to the channel for more educational content on finance and wealth building. What is the one index fund you are considering adding to your portfolio first? Let us know in the comments below.